Hello, I'm James and today I'm going to be talking about final pay controls. So I'm going to look at what final pay controls are, how they work, give you some advice on that and then give you some links to further guidance. Final pay controls were introduced in April 2014 to overcome an issue where some people were being given large pay rises in the final 3 years before their retirement, which then led to an increase in their pension. This was felt to be unfair, and so final pay control mechanism was brought in at that time to remedy this, and now I'll explain further how that's calculated. So they come about when somebody has an increase in their pensionable pay above an allowable amount, which is the definition I'll give in a moment, in the final 3 years of service, which is when their final pension is based on, and not arising from a genuine change of role, which would be unfair. They are applicable to those in the 1995 section of the pension scheme with officer benefits. So we're looking here at nurses and practice managers predominantly. There may be some GPs with mental health officer status who are also in the officer scheme, but here we're really looking at nurses and practice managers that are affected, particularly when they become partners, because the profits are variable then, and you'll see why that makes a difference in a moment. Who pays it? The invoice, if it comes through, would go to the GP practice or employment authority automatically. Whether the GP practice is the one that finally pays it will depend on the partnership agreement and what you've done in your practice in this eventuality. You have to recompense the pension scheme for the full cost of the pension increase for the pension member, and the calculations will show you what that means in a second, based on whole time earnings, and they can easily reach over £100,000 in real life cases. So how is it calculated? I mentioned that phrase, the allowable amount, a moment ago, and this is the definition of it. The key one here being the increase of 4.5% above CPI inflation. That's from the previous February's CPI inflation. You're allowed to give people pay rises, or they're allowed to increase their pay and have increase in profits within that threshold, but when you go above that, that's when the issues start to happen. And now I'll walk you through the example that's on the NHS Pensions Agency website. So here it is. Looks fairly innocuous on the face of it. Somebody who's being paid £25,000 going up £2,000 a year, then having a £4,000 pay rise in the final year when they retired. Let's see what happens to the calculations when you run them on these numbers. So here, you start with the base year, £25,000. As I mentioned, you're allowed 4.5% above CPI. CPI inflation in February 16 was 0.3%, so you add that to the 4.5%. 4.8% on top of 25,000 is 26,200. So that's your allowable amount for year 3. Now we're into year 2, we take that 26,200 figure, add 4.5% above CPI inflation to get a figure of 27,981. Because we've got a couple of years data now, we also have to do this A over A plus B formula, which gives a result of 28,140. And if you remember back to the bullet points earlier, it's the lesser of these three calculations that you have to take. So the pay of 29, 27,981, 28,140, the lesser of these three is 27,981. So that is relevant because that becomes your allowable amount moving into year 1 coming up. Year 1, this is the final year. So pensionable pay 33,000, take that book forward again, add CPI inflation, the allowable amount is 29,520. So because this person's pension will be based on the 33,000, it's really this one that you have to be careful of. So if I show you in a second what that all looks like in summary. Have the table here, here's the figures with the allowable amounts, and you can see in that final year the 33,000 tested against the 29,520 is an excess of £3,479. As your pension is going to be based on that 33,000, it's that 3,479 which is key, and the calculation as to how this turns into a final pension is coming up. Now we take the 3,479 and you multiply it by the number of days. So 7,300 days is 20 years, 29,200 days is 80 years, it's a 1/80th pension scheme. So that 3479 would give that person an extra £869 a year pension. You take that extra pension, multiply it by a factor, which in this case is 20.6, which roughly equates to life expectation, so 20 years, and plus the excess lump sum, which is 3 times multiple in the 1995 scheme, so another 2609. The final pay controlled tax charge, with which would be landing on the practice's doorstep in the form of an invoice, would be £20,528. So recapping, somebody's pay is increased by £4,000 and the practice would get a tax charge of £20,528. If that person had 35 years service, that extra pay would have given them an even bigger pension, and that would have resulted in nearly £36,000 worth of tax. So you can see here that fairly modest looking pay rises on paper can give rise to very large invoices coming in the post. So you're probably thinking now, how can you avoid these tax charges? And the first thing to point out is you cannot take retrospective action on these. Once somebody's pay has been submitted, that's it, it's set in stone, you can't go back and change that. So the important thing is to preempt by ensuring that people don't have spikes in their income above that 4.5% over CPI. Also ascertaining genuine role changes, which would normally mean changing employer as opposed to having a different role at the same surgery. And also just understanding people's retirement date intentions. If you give them a pay rise more than 3 years out from retirement, then you're probably clear on the basis that they won't be drawing their pension until that flushes through the system. So if you've got somebody that's very close to retirement age 60 in the 1995 scheme, then just keeping a very close eye on their pay in the last 3 years. So other things you should do, update the partnership agreement. It is important to decide who will be paying this tax charge. It's based on the extra pension that the member will receive in their lifetime, but the invoice will automatically go to the practice. So you need to decide whether it's the retiree or the partnership that pays this tax charge if it arises. Also, if there are future incoming partners, it may be that one of these tax charges land after the practice manager has left the surgery, if they leave in that last couple of years, and I'll give an example of that in a moment. So any future incoming partners who may never have even met this practice manager may be on the hook for this invoice, so how are you going to indemnify them? And also any partners that leave the practice partnership over that period of time, is it fair that they should be liable for part of the cost if they were in situ when the increase happened? So those are all things to think about and address in the partnership agreement. So the complex scenarios here, I mentioned earlier, nurses and practice manager partners who have variable profits from one year to the next. Very easy for profits in a practice to exceed 4.5% over CPI from one year to the next due to the variability of them. You may think that your practice manager has been doing a good job of looking after the primary care network, for example, so decide to either give them an increased pay or a pensionable bonus. That can trigger these tax charges, final pay control charges. So if you are to give any bonuses, just consider whether they need to be non-pensionable. Ill health retirement's caught, very important point here. If somebody is planning to retire at age 60 but then things happen in their life and they get caught by ill health, have to retire early, then that will trigger the 3-year look back for final pay control charges. So even with the best will in the world and thinking that somebody's not about to retire, they can still be caught. Also other complex things is if somebody's got multiple employers, clinical excellence awards in trusts, breaking service, and etc., all may add complexity to this already complex charge. Here are some links. So this is the Pensions Agency guidance, which is the example I've just run through earlier on. There's also longer government guidance, 19 pages there, which is much more in-depth and useful to look at these more complex scenarios. I'm just going to take one example from that longer guidance as well, just as a final example here. So this is somebody who had a genuine change of employment in their final 3 years, just to show you how that part of the mechanism works. So you can see there, employer 1, they were earning 59,000, small increase to 60. Then halfway through the year of 2015, they left. So we can see £35,000 there for that half year. So they did experience some increase in pay. That increase in pay could look like a £5,000 bonus. For example, if the employer got wind that they were looking to change, maybe they gave them a bonus to try and keep them on board. That didn't work. They moved to employer 2 with a base salary whole-time equivalent of 90,000, so 45,000 for that half year. They then got a pay rise to 97,500 there. So if we look at the tax charges that will land on each employer's lap, here we can see employer 1 would incur a tax charge of £63,000, which may come as a surprise on the basis that the larger figures are incurred in employer 2, but employer 2 gets that benefit of the genuine change of role, which means that 97.5 is tested against a £90,000 whole-time equivalent, and it was that jump from a 60,000 to seemingly 70,000 in employer 1 which triggers the huge tax charge. So genuine change of roles does not mean that the first employer gets away with the charge. It just means that employer 2 gets that excess suppressed slightly. So conclusion, nasty charge this one. Many people, it was designed to catch people that were trying to game the system and give people extra pension in their retirement. It is now catching people inadvertently, particularly partners with variable profits, but also those who are just giving their people bonuses and pay rises in year very genuinely, wanting to recompense people and reward people. So watching out for that 4.5% over CPI inflation is important. Planning in advance, although as I mentioned earlier, you can't plan for ill health, so there's only a limit to that, and watching nurses and practice managers becoming partners particularly. Thank you for listening, and I hope you found this useful. If I can help any further, then please do get in contact, and I look forward to seeing you soon.